Oil is starting to climb. We've got Brent at 110. We got U.S. crude at 101. So let's talk to Ben Willis of Sunrise Securities. You've been a big supporter of oil investing. You've been very much an oil bull. So what's happening now with, we obviously know there's issues going on in Iran, but let's talk about the whole picture. And are you still that bullish, or have we started to get toppy on this?
Well, I would say if you believe in the manufacturing numbers themselves, that we're not being toppy. That oil probably still has upward potential. As a matter of fact, we're now at $102 a barrel in West Texas Intermediate as we speak. And there's another dynamic going on there about the spread between the West Texas Intermediate and North Sea Brent, which is, leave that to the traders in the pits on how they want to figure that out. But just worth something keeping in mind when you see oil trade some days not as you might think it would. But you have the manufacturing number, which is very positive, which says growth, which means demand for oil, particularly in China as they grow and manufacture their automobiles. But then you have the situation in Iran with the Straits of Hormuz, which adds the fear factor. So you have some bullish tendencies in the market today, but carrying forward, assuming that the Iran crisis will ease away, the situation is manufacturing, if it continues, is not going to happen, and that's going to continue to demand. And then the triple play on this is the dollar effect. As the dollar continues to change its direction, that will also have an impact on the pricing of oil and its ability to continue to rise in price.
Is it easier for investors to go after just a single big name, pick up some ExxonMobil, or is it better to go with the ETFs like maybe an oil service, or what's the best way to do this?
Personally, I prefer to stay away from what you mentioned. I can't talk about individual stocks, but if I were investing my money and other people's money, I'd have a tendency to look to the smaller regional players or the not so common names. I mean, today you had a story about Chesapeake selling assets that they had to Total because of the value that the rest of the world is now finding in the shale oil and the shale reserves, if you will, throughout the United States of America. Chesapeake was smart enough to buy that for a lot less money years ago, and they just sold 25% of the holdings. That's the kind of place you want to look. You want to look to the smaller names, the service names. If demand continues, demand for oil rigs is going to go up again. That's where I look. The big names, yes, they're great. You want to buy those big names, as you mentioned. To me, you want to buy them when they come for sale on any given day, because that's going to help your long-term average as far as return and the dividends that those big companies pay, which is not a bad way to make money in the end. I mean, that's where you made money in the S&P, is just on the dividends this year. So that's my idea behind it.
All right, so it sounds like Ben's still sticking with his energy bull status. Here's the suggestions. If you're going to look at single oil names, go for the smaller ones where you might get more upside, or look at oil services. And of course, there's some great ETFs in the oil service side.